mobile app, on your Alexa-powered smart speaker, and on TuneIn, iHeart, and on Odyssey.
Now, from the Signature Bank Studios.
America First with Sebastian Gorka. Today at 3, right before Sean Thompson at 4 on AM 560. The Answer.
Top of the morning, Dan and Amy. You know, more dumbassery by our experts in charge. Fed Chairman Jay Powell thought he was talking to Ukrainian President Zelensky, according to a video shown on Russian state television. But he wasn't. It was a prank call by a couple of Russian pranksters posing as Zelensky. Nonetheless, I mean, he didn't embarrass himself on the substance. He just embarrassed himself by being clueless and the people around him and what kind of security checks and I mean, knowing who's call. I mean, it's just, how does this happen? The incompetence.
Was it the Jerky Boys?
It was not the Jerky Boys.
I gotta.
Because
how do you know?
Nobody called him Sizzle Chest.
Oh,
that's
okay.
how you know. Yeah. Or told him to get Brent where I said. Or said
bring them back.
And nobody said they were going to sue Jay Powell for the damages that you're giving me. The punitive damages. Okay. All right. I'm sorry. All right.
Oh, it's great. We digress, but it was a good.
We'll do Jerky Boys impersonations some more later.
Yeah, at the 8 o'clock hour.
Jay Powell had this to say.
Oh boy.
About the economy, the likelihood of recession, the problem of inflation.
But what we're going to find is that growth in 2022 was positive but modest. It was subdued. So, 1% around that level. In terms of this year, most forecasts call for the U.S. economy to continue to grow, but at a pretty subdued level. So growth of less than 1%, let's say. But we would tell you that a recession is almost as likely as very slow growth. So that's a fact, and I think that is partly because of us having raised rates quite a bit. But this is what it takes to get inflation down. To get inflation off of the high, we've had inflation at its highest level in 40 years. To get inflation to come down, what we need is a period of slower growth so that the economy can cool off, so the labor market can cool off, so that wages can cool off. And so that's how inflation comes down. That's the only way we know to bring inflation down. And it can be painful, but we don't know of any painless way for inflation to come down.
That may be the only way that Jay Powell knows over at the Fed, but is it the only way? For more on this, pleased to be joined by Alex Pollock, Senior Fellow at the Mises Institute, served as the Principal Deputy Director of the Office of Financial Research and the Treasury Department, former President and CEO of Federal Home Loan Bank of Chicago as well.Alex, thanks for joining us. Appreciate it.
Good to be with you again. Good morning.
What is your reaction to what Jay Powell said? The idea that we could be in recession by the end of the year. This is not a novel prediction. So more so the issue of this, nuking people's brokerage accounts, raising rates. This, although it's not nuking them at present, we'll see. This is the only way to get inflation down, is it?
What we never hear is how, in such comments, is how inflation got up and out of control in the first place.
Of course not. Everybody's innocent bystander.
Which is that's it. Which is due to the printing by all of the central banks, led by the Fed, of course. And once you have done that, there is indeed a cost to pay. Henry Hazlitt, who was a great writer on inflation in a previous generation, said the government always pretends that inflation is this force that's coming from outside that they have to fight. We have to now fight inflation, says the Federal Reserve or the central banks and the government, but without mentioning that they caused it in the first place. So they're fighting their own creation.
Yeah, well, I don't think Jay Powell read economics in one lesson. It doesn't seem like it.
I don't think so either.
Yeah. But what about? I mean, this would be outside of his lane, but couldn't Jay Powell say, one of the things that would help is on the fiscal side of the house if the policymakers in D.C. move to make energy lower cost and more ubiquitous, moved in the direction of America regaining its status as energy independent. Help on the production side.
That would make perfect sense. In the end, of course, the real standard of living is all about production, and over the real production, we have the dancing of the financial markets and their values, and of course, there is the cutting down of the deficit spending, which is only possible if financed by the Federal Reserve. So those things make perfect sense, as you suggest.
First Republic Bank, now the property of, or the assets, deposits, property of J.P. Morgan. And this is interesting, the timing of this, because it comes after the Fed released on Friday the vice chairman's report on the Silicon Valley Bank collapse, Michael Barr's report, in which he basically says that regulators didn't respond fast enough. They were not watchful enough, and so the solution for this lack of vigilance is to give the Fed more power.
Yes, well, of course, the Fed always would like more power, and interestingly, historically, they get it. We may have talked about before Scholl's paradox, which comes from a very wonderful book on the history of the Fed written by Bernard Scholl, who was a friend of mine. And the paradox is no matter how much the Fed blunders, they always end up becoming more powerful and more prestigious. This is an odd thing in history. They're going to try again. On the Michael Barr comments, of course, Michael Barr is new, so what he's doing is actually criticizing his predecessor. Well, the previous administration followed this up, but if you could just give me a lot more power, I'll do it. I'll do it right. It's so hard to know the future. As we know, the financial and economic future is indeed unknowable. But it wasn't very long ago that we were hearing from the Fed and all of the Washington crowd what a great shape the banking system was in. We may have had these other problems. We have inflation. We have markets falling. We have cryptocurrency failures. But thanks to our great regulation, the banking system is in great shape. It's all these non-banks we have to worry about. And the next thing you know, we have banks failing, runs on banks, which were thought to be a thing of the past, and the regulators scrambling around to declare this systemic risk that requires the bailout of billionaire depositors and big losses to the government and its insurance fund, as again here in this First Republic case. I think we can confidently say that giving the Fed even more power than it's already got will not solve this problem.
Well, where were the regulators? I mean, especially for Silicon Bank and now First Republic Bank. And how many more banks are going to fail like this? Because this is pretty scary stuff. I mean, they had 93 offices in 11 states, but of course they were also based in San Francisco.
Yeah, well, these were big and important banks, and very well thought of, and First Republic in particular, up to quite recently, was thought to be a wonderful, very successful bank. Its shares have fallen 98%. They're going to go to zero, I guess. So that'll be 100%. And so what you think is a great thing one day, the next day is a complete failure. Now, that happens in financial and banking markets regularly in history. Now, the problem is in these banks and in a lot of banks, induced by the Federal Reserve's very long decade of suppressed both short-term and long-term interest rates, they engaged in the most classic financial mistake of all, which is investing very long at fixed rates and financing them short. Makes you, of course, extremely vulnerable to a rise in the level of interest rates. They didn't think it would happen. Neither did the Fed think it would happen. In the spring of 2021, the Federal Reserve Open Market Committee, looking forward to the end of 2022, predicted that the Fed funds rate, in other words, the level of short-term rates, would be, guess what? Do you happen to know what their prediction for the end of their prediction made in, let's say, March 2021 for the end of 2022 was? Well, their prediction was 0.1%.
Oh.
The actuality was 4.5%. So they were only off by 4.5%. By a factor of about 45.
Yeah, that's about right for government. That's the sweet spot.
The Fed playing the role of Casey at the bat. and striking out. Well, then the Fed, in its own balance sheet, as we know, made the same mistake that these other banks made. So the Fed itself is now, as you know, losing vast amounts of money. Its aggregate losses as of last week are up to $52 billion. That's an interesting number. So there was this whole sense on the part of people, well, these interest rates probably won't go up, and then we won't pay the price. But in fact, once the cost of the expansionary monetary and, as you rightly point out, fiscal policy came home to roost, inflation out of control, rates up, and they did indeed pay the price, a much bigger price than they ever expected, and a much bigger price than the regulators expected, trying to look into the future. So as an old banker taught me a long time ago, risk is the price you never thought you'd have to pay, and now it's being paid.
Well, and fill in the rest of the picture from your perspective as a former executive, a bank executive, about what is going to come with banks, particularly as it pertains to their commercial real estate holdings. Our friend.
Well, there's that too. Yeah, there's the interest rate risk, and of course, a classic temptation in banking is to overexpand credit on commercial real estate, and commercial real estate is a repetitive character in banking bust. So now we know that in the banking system, not everywhere, but in many places, there are very large interest rate risk positions, like we saw in these failed banks and in the Federal Reserve itself, induced by the Fed. And along with that, there are large risk positions in credits to commercial real estate, and that it takes quite a while for the commercial real estate problems to work through. So if you go back to 2020-21 with the lockdowns and the stopping of people going into the offices, all of the tenants, the companies that had rented space still had their leases. They were still paying to lease quarters, which were often virtually empty, and but those leases ultimately run out.
Well, right. So the question is, I understand. So the question is, when does that manifest itself, so that we understand the depth and scope of the problem? Do you have any sense of what we're potentially looking at, and on the timeline we're going to be feeling it?
I do not, but I would say that the sense is over the next year. The rest of this year and next year, we're going to be feeling it, and then how bad it is, of course, is what we all guess about all the time. But you're right in thinking of the banking system. You got at least these two things going on: the interest rate problem and the commercial real estate problem. But they're tied, because when you make it much more expensive in higher interest rates to carry real estate, then the prices go down. And we have already seen cases now, the landlords giving back the buildings to the lenders. There'll be more of that. What we all try to guess about is, and nobody knows, is how much. But the time is coming now. This is 2023. The finances are going to have to be rolled over. Leases will be running out. So I think we'll definitely see this over the next 12 months.
And based on what you heard from Jay Powell in that prank call, Do you anticipate the Fed hiking rates another quarter point this week?
I would think so. They're up against it. The inflation is still there. And remember that interest rates, as we may have talked about before, are not high. 5%, historically speaking, that's an average interest rate. And the same with mortgages at 6%. That's an average mortgage rate. They just feel high to us because we had a decade of extraordinarily depressed rates and robbing savers by the central banks and governments. So now trying to get back to normal feels very challenging, and it will be challenging because we're going to be paying the price for the actions previously taken.
He is Alex Pollock, Senior Fellow with the Mises Institute, former President and CEO of Federal Home Loan Bank of Chicago. Alex, thanks again for joining us. Appreciate it.
Great to be with you. Thanks again.
Thank you. And he joined us on our turnkey.pro answer line.
You've made the switch, and it feels so good. You've switched to Chicago's Morning Answer on AM 560. The Answer.
Foreman is the heavyweight champion of the world.
Now, experience the movie based on the miraculous story of George Foreman.
George Foreman ain't no new champ. He is the new chump. Foreman is down.
I'm not going to box anymore. I'm going to follow God.
It's the greatest comeback story of all time.
There's only two things I know how to do. Box and preach and won't pay the bills.
Foreman's 45 years old. The risk isn't losing, it's surviving.
How can you beat that man?
I'm going to do this my way.
Big George Foreman, now playing exclusively in movie theaters. Rated PG-13, may be inappropriate for children under 13.
Relief factor, pain relief that's natural, pain relief that works, and pain relief that attacks the source of the pain. That's the experience of tens of thousands of Americans who are taking Relief Factor right now. See their incredible video endorsements at relieffactor.com and then order your 3-week quick starter pack for just $19.